Hi, everyone, and welcome to our channel. I'm Mama Michelle Head, CPA, a nonprofit certified public accountant specializing in nonprofit organization, founder of Overhead Solutions Group. Today, we're diving into a topic that's crucial for any nonprofit's financial health. As mentioned before, a nonprofit should have multiple forms of income. The one I'm discussing today is investment strategies. So let's get started. So, investments might sound like a term reserves corporations, but it's equally important for nonprofits, whether it's an endowment fund, short term reserves, or long term growth. Understanding where and how to invest your funds is key to sustainability. It all starts with a solid investment policy statement, or IPS, which is like a roadmap for your investment journey. So, there are three different types of investments. There are endowments, which are funds that nonprofits set aside to support their operations or specific purposes indefinitely. The principal amount typically is kept intact and not spent, and only the investment income is used. Endowments are investment with the goal of maintaining or growing the original fund while providing a steady income stream. There are short-term investments. Short-term investments are assets that a nonprofit expects to convert into cash within a year. These are typically liquid and less risky, such as money market funds, certificate of deposits, or treasury bills. The primary goal is to preserve capital while earning a modest return. Long-term investments. Long-term investments are assets that a nonprofit plans to hold for more than a year. These could include stocks, bonds, mutual funds, or even real estate. The aim is to achieve higher returns over time, accepting risk and more volatility in exchange for potential or greater income or capital appreciation. Each type of investment serves a different purpose in a nonprofit's financial strategy. It must be managed according to the organization's goals, risk tolerance, and investment policy. An investment policy statement is a critical document for nonprofits as it outlines the organization's investment goals, strategies, and guidelines. Here's why having an IPS is important. Clarity of purpose. An investment policy clearly identifies and defines the investment objectives and the financial goals of the nonprofit and ensures there is a mutual understanding among all stakeholders about what the investments are intended to achieve. Risk management. The investment policy sets forth the risk tolerance of an organization, detailing what levels of risk are acceptable. This helps in selecting the appropriate investment vehicle and avoiding those too risky for nonprofits' profiles. Asset allocation. It provides guidelines on how the assets should be allocated across different asset classes, which is essential for diversification and risk control. Performance monitoring. The IPS establishes benchmarks and performance expectations. This allows for regular evaluation of investment returns and comparison with relevant standards. Fiduciary responsibility. It serves as a guide for investment managers and board members, ensuring that their decisions align with the nonprofit objectives and no legal requirements, thus upholding their fiduciary duty. And of course, as mentioned before, no individual owns a nonprofit. The nonprofit is owned by a public. Therefore, it should always have accountability and transparency. An investment policy statement promotes transparency and accountability by documenting the investment process and rationale behind investment decisions made. Overall, an investment policy statement, or IPS, is a foundational tool that guides nonprofits to make an informed and strategic investment decisions and ensuring the long-term financial stability of the organization. So, another thing you really should do is make sure the investments align with your mission. Now, it's not just about making money, it's about making money that works for your mission and increases the value and helps the community. That's where mission related investments, or MRIs, come in. These are investments that not only generate financial returns, but also further your cause. And let's not forget about program related investments, which directly fund programs aligned with your mission. Plus, you should also do some sort of socially responsible investing as well. It's really well rounded when making investments. They should be really directly related to programs you do, have a good social impact, and they should be mission related. So, way to think about mission related investments, or maybe some good examples of a mission related investments, is maybe doing loans and microfinancing. So, providing low interest loans to small businesses or microfinance to individuals in underserved community to spur economic development. or bonds, investing in bonds that funds programs like green infrastructure, which will align with your nonprofit if you have an environmentally sustainability goals. Equity financing. You could take on equity stakes in social enterprises that work towards objectives that align with the mission of your nonprofit. So, for example, if your mission is to have affordable housing, you may want to take an equity stake in the social enterprises that help others get affordable housing. Now, another thing you should think about is it program related? And now here are some things you can do, to do program related investments. So, for example, if the purpose of your nonprofit is to help students or to help people get an education, you can offer low interest or interest free loans to needy students to help support their education. Again, if you're supporting low income housing or helping people get housing, you can make high risk investments in nonprofit low income housing projects to provide affordable living options. And another thing to do is support small businesses. So providing low interest loans to small businesses owned by economically disadvantaged groups, especially where commercial funds are not readily available. These type of investments allow nonprofits to further their mission while also achieving financial returns or sustainability. Mission related investments. So MRIs typically aim for market rate returns of the organization overall investment portfolio, while what we discussed in program related investments are more closely aligned with the nonprofit's programmatic work. In the perfect world, you'd have a mix of both some mission related investments and some program related investments. But we also shouldn't forget that the investments should be socially responsible. So, socially responsible investing plays a significant role in aligning the investment activities with ethical and social value. Here's how, socially related investment impacts both and how it really should be handled. So, responsible investing focuses on investments that contribute positively to social and environmental changes. This includes, when you decide which stocks and bonds and things to invest in, supporting companies that engage in sustainable practices, social justice practices, and responsible corporate behavior. So, the things they do are aligned with what your mission and how you are helping to financial returns should align with your values. Investors who practice this aim to achieve competitive financial returns while also ensuring their investments reflect their personal and organizational value. This dual focus allows for financial growth without compromising the ethical standards or your mission. And when you do this, you really should screen and be very selective in what you invest in and what you do, and make sure it has an overall positive impact on your company, but not just that, an overall positive impact on the community as well. So you need to seek out companies that actively contribute to societal and environmental betterment. Now, another good thing about, being socially responsible when you're investing is that by choosing it based on social responsibility criteria, the nonprofits can influence companies to adopt better practices. Things that are more aligned to their mission and better for the community. This can lead to broader changes in corporate behavior and industry standards. In summary, you need to be socially responsible. You are investing as a nonprofit. This allows the nonprofit to contribute to societal and environmental progress while pursuing their financial objectives. Of course, when you invest, you would like your investments to grow. So, of course, you should invest with the purpose of gaining, having monetary gains, but you should also be doing it in a way that's aligned with your mission, and that is also ethical. Now, one thing you should think about, and something you will hear lots of times when people are talking about their own personal finance or business, is that you should have diversification. So, diversification is a term you'll hear a lot in the investment world. It's about not putting all your eggs in one basket. For nonprofits, this means creating a balanced portfolio that can weather the ups and downs of the market. Understand your organization's risk tolerance is crucial here as it guides your investment policies and help you protect your assets. Risk tolerance is a degree of variability in investment returns that an organization is willing to withstand. Key component of an investment that organizations now, risk tolerance is a degree of variability that an organization is willing to take. It's a key component of investment strategy and varies widely among organizations due to several factors. What you can and can't, invest can depend on many things, such as your financial health and reserves. Organizations with robust financial health and significant reserves, and by significant reserves, I am meaning they have a lot of cash. There's a significant amount of assets readily available. And they could typically afford to take more risk because they have more of a cushion to absorb any potential losses. Now, an investment time frame, which investment is going to make a difference as well, because usually you can tolerate more risk if your organization is investing more in longer term kind of investments. So that means you have more time to recover the market downturn versus if someone wants to invest their money, but they know they will need to use the money sooner, they can't take on as much risk because the funds need to be available. And mission and values. The mission and values of an organization can influence its risk tolerance. For example, a nonprofit focused on environmental conservation avoid investing in fossil fuels despite the potential high returns they can get from that. So cash flow needs. Organizations with regular, predictable cash flow needs have a lower risk tolerance as they rely on the certainty of income from their investment. Board and stakeholder preferences. The risk preferences of organizations' board members and stakeholders can also impact its risk tolerance. A board that is risk averse may opt for more conservative investments. So, of course, whenever you make these investments, you need to make sure the board is on board and that you really have something leveled out that everyone can agree to. So, balancing an investment portfolio is key to mitigating risk. Here are some tips nonprofits can use to help balance their portfolio effectively. You need to diversify across asset classes. You really shouldn't concentrate all of your funds in one type of investment or one specific stock or bond or one specific piece of real estate. You should really, as mentioned, not put all your eggs in one basket. You should match your investments to goals. You need to align your investments with your financial goals and time horizons. For example, if you have a long-term goal, you might include more equities in your portfolio. Understanding risk versus return. Higher returns usually come with higher risks because your desire for returns with the amount of risk you're willing to accept. So do not invest in high risk investments. You do not have the cushion or availability to invest in it, or if it's not in line with your investment policy. You should regularly review because the market goes up and down all the time, especially if you have an intended asset allocation, like this percent goes to this allocation, this percent goes to that. You should regularly review and make sure your assets within that allocation, which we'll talk about later, is if you have an investment professional working with you, they should be checking on those things as well and helping you with that to make sure everything is in there. And of course, you should always, always, always consider your liquidity needs. You need to ensure that you have liquid assets. By liquid assets, that means cash to use. You should not put so much funds in investing that now you don't have cash to use in your day-to-day operations of the organization. And you should always monitor market conditions. You should stay informed about market trends and economic conditions that could affect your investments. And always stay clear and have a policy about stop loss. So for certain investments, maybe setting stop losses to automatically sell off assets if they drop below a certain price point. Potential losses. By following these things I just mentioned, you can create a well-balanced portfolio that aims to minimize risk while working towards achieving their investment goal. Now, another thing, of course, I'm going to stress is working with investment professionals. Even if you are very savvy with numbers, navigating the investment landscape can be very complex, especially for a nonprofit. That's why partner with a financial advisor or an investment manager can be invaluable. They can help tailor your investment strategy to your nonprofit specific needs. Just make sure to do your homework and choose someone who understands the nonprofit sector and has a track record of success. When selecting a financial advisor or investment manager, consider the following key factors to ensure they align with your needs and objectives. So, you should make sure they have the correct credentials and experience. Verify their qualifications, such as are they a CFP? Are they a CFA? So a certified financial planner or a certified financial analyst, and experience in the financial industry. You need to look for professionals that not only have strong experience in the industry, but specific strong experience in working with nonprofits that understands their needs and how to track. And make sure you choose someone who has a fiduciary duty. So that means when you're choosing your investment manager or financial planner or advisor, They are legally obligated to act in your best interest, not their own financial gain. And you should also make sure the services they offer are in line with what your nonprofits need and what you are doing. So you should understand. Another thing is you need to understand their investment philosophy, understand their approach, and ensure it matches your risk tolerance and investment goals. It needs to be someone who is willing and able to work within the investment policy that your organization set up. So you should ask about how they handle market volatility and their strategies for your asset allocation. And of course, the compensation structure, because nothing in life is ever really truly free. So you need to know how the advisor is compensated. Is it fee only? Is it commission based? Is it a combination of both? Fee only advisors may have fewer conflict of interest, so that may be the better way to go. And communication and accessibility. You need to make sure that they're willing to communicate, and you need to see how available they are and how often they're communicating and how long it takes them to get back to you, because you really want to work with someone who is accessible, very responsive to your needs and inquiry. And you should also look at who they worked for. You need to make sure that they have clients that are similar to yours, especially that they've worked with other nonprofits in terms of assets, life stages, and financial challenges, because they would have each expertise needed to help your organization. And of course, you should always check their reputation and references. Make sure they have good reviews, testimonials, and make sure they don't have any disciplinary history with regulatory bodies like the SEC or the FINRA. By carefully evaluating these aspects, you can find a financial advisor or financial manager, investment manager, who is well suited to help you navigate your financial journey. Conducting due diligence and regularly reviewing your investment portfolio is essential. So here's some way to approach these tasks. So, on top of having an expert, you should also do due diligence. So you need to research any potential investment, including their financial health and track records of the companies you're considering. Assess the risk. Make sure it's overall within your risk tolerance. Again, consult with experts. Never do any of these things on your own. You need to consult with financial advisors or investment professional, especially when you're making complex investment decisions. Regularly review it. Even if you do have a financial advisor or investment manager, you, the nonprofit, should be reviewing these funds and the way the money is going as well. You need to monitor the performance against benchmarks and goals, and making sure it's aligned with your investment policy and portfolio rebalancing. You need to make sure you're always adjusting back to your desired asset allocation. In other words, you need to stay informed on what's going on with your investments and making sure they're in line with your organization. Now, last but not least, we should really talk about regulatory compliance and ethical consideration. Because, as you may or may not know, there are special rules for how nonprofits can deal with investments. So let's touch on the legal side of things. Nonprofits tend to adhere to certain regulations with investments, like the Uniform Prudent Management of Institutional Funds Act, which going forward I'm going to call it UPMISA. That is a mouthful. And beyond the law, there's ethics. Being transparent and accountable when your investments isn't just good practice, it's a reflection of your organization's integrity. UPMISA is a significant statute that guides nonprofit organizations in managing and investing their funds. Here's an overview of the UPMISA. It provides a legal framework for the management of institutional funds held by charitable organizations. It offers guidance on investment decisions and endowment expenditures, aiming to ensure that those funds are used prudently and in line with your organization's investments. Some of the key objectives is you need to have prudence in your investment. So you need to make sure that when you're making this investment decisions, you're considering factors such as economic conditions and the potential for you to make income from these investments and appreciation, and the organization's other resources they have. And you should have a spending policy. This is for nonprofits to adapt a policy that improves and consider long-term preservation of an endowment fund. So, and you should also make sure you have a delegation of management. Organizations to delegate the management and investment of the funds to external experts. But when and if you do this, you need to make sure they provide care, and you need to make sure you're doing a good job in selecting the right agent, and not only selecting the right financial advisor or investment manager. Continue to monitor the performance. And that's all within UPMIFA guidance given by the federal government. And it plays a crucial role in helping nonprofits manage their assets respectively. So whoever you deal with, whether it's the investment manager, um, financial advisor, someone internally within your organization, they really need to understand the law and what nonprofits can or cannot do when it comes to invest. So, in conclusion, here are a few key things I hope you took away from this video. Make sure you have an investment policy and make sure that policy is aligned with your organizations and their mission. There are three main type of investments a nonprofit can do, whether it's an endowment fund, short-term investments, or long-term investments. You can do one, you can do all three. And make sure you align your investments with your mission. So, in other words, you need to make sure your investments are mission related, program related, and that they're socially responsible. Always, always, always make sure you have diversification and risk management. You never want to put all your eggs in one basket or in one specific stock or one specific bond. You want to make sure you use prudence. And by that, I mean you need to make sure you're working with investment professionals, but not just any investment professional, someone who's certified and someone who knows what they're doing and have exact experience with your nonprofit. And always making sure you're staying within regulatory guidelines and compliance and staying ethical. As mentioned, you need to adhere to the laws within the UPMIFA. So, investing in nonprofits means being smart, strategic, and aligned with your mission. It's about managing risk and diversifying your portfolio and working with professionals who can guide you along the way. If you have any questions or need personalized advice, don't hesitate to reach out to us at Overhead Solutions. We're CPA specialized in nonprofits. Thank you for watching. And if you found this video helpful in any way, please like, share, and subscribe for more insights. Also, check the link in my bio for a free ebook I have out there. Until next time, keep making a difference.